going. So my guest this week is Alex Crooke from Bankers Investment Trust. So we'll be talking to him in a bit, but obviously, as usual, we've got some news to have a look at first. And thirdly, obviously, I'm going to be talking about the proposed merger of HICL and TRIG, Foresight Solar, and also Murray Income. So we'll start with HICL and TRIG first. This is the HICL chart, and obviously not that pretty. And you can see the share price diving off at the end there after the announcement of the deal. And quite a wide discount now, so about sort of going on for 31%. And that is the TRIG chart. Also not pretty, and there is a small uplift at the end, but it's really not very big, and that's still on a 31.9% discount. So the deal that they've announced is for HICL to buy TRIG, but it's structured as it's the Guernsey equivalent of a Section 110 scheme. It's something we talk about all the time here. So basically, you take the NAVs of the two companies, you knock off the costs, and then you smash them together. And they're basing it on the NAV as at the 30th September. So we actually know what the ratio would be, which is there on the screen. If you're a TRIG shareholder, you also get a cash exit option, but only for about 10.8% of the company. And there's no cash exit option if you're a HICL shareholder, and we'll come on to why that is wrong later on. And that cash exit is going to be done at a 10% discount to the NAV. So very roughly, 250 million quid at a 10% discount means there's 27.8 million of uplift to the NAV. And that is split 50-50 between the HICL and TRIG shareholders to help offset some of the costs of doing this. And the other sort of positive thing on this is that Sun Life would buy £100 million worth of HICL shares in the secondary market after the deal to try and help kind of steer the ship a bit. And they say that they've talked to large shareholders and had positive feedback from them. Which a lot of people are finding quite surprising, but nobody's come out and denied it yet. So obviously the manager stays on as the manager of the combined portfolio because InfraRed run both funds. The fees are tiered as you might expect, and they're slightly lower. They're based on an average of market cap and NAV, which isn't ideal, but this seems to be the route that the renewables industry has gone down. Obviously, if it's on a 30% discount, that makes a big difference. And so that works out, they reckon, at about an expense ratio of about just under 1%. And Res, which is the sort of other bit of the manager, will stay on as operations manager, and then it's got a tiered fee as well. And it's getting compensated as though that 250 million cash out hadn't happened. So for the first year, so its NAV, its adjusted NAV is slightly higher than it would be otherwise. And they are both on 3 years' notice, which falls to 2 years' notice when we get to April 2030. Now, what the smashed fund is going to be is slightly different. So they're going to target growth, and we'll look at that a bit more in a second. And they're looking for a 10% total return on NAV. Because obviously the TRIG yield is a lot higher than the HICL one, to kind of sweeten the whole pot, they're going to put the HICL dividend up from 8.25p, where it's been flat for ages, to 9p. And they said it'd be covered about 1.1 times. And they also say that there's going to be a progressive dividend policy. So you could see that dividend rise over time. So say HICL's been flat for 8.25 for a long time. We'll go up to 9, could rise from here. One of the classic things with mergers is the idea that some directors lose their jobs, but here that's not the case. So you go to a board of 11 members. Everybody keeps their jobs. But they will reduce the number of directors over time. There's no timetable for that. There's no target number, nothing like that. And they are motoring ahead with this, so we should see a proper circular announced soon, meetings in December, and aim to complete it within the first 3 months of 2026, if all goes to their plan. Now, I said that the strategy is shifting a bit. So really what they're trying to do is bring in more kind of growth into the mix by investing in things at an earlier stage. So actually developing projects and that sort of stuff, which means higher risk, obviously, but higher potential returns, but lower cash yield up front. So there's kind of shift from what they do normally now towards that kind of growth type thing, which is something actually that Octopus has been doing for a while. They've been trying to develop more projects and push returns on that way. I don't really have a massive problem with that. But obviously you have to watch what the impact is on dividends, and you also, it does represent a sort of change of the risk profile for investors. So especially if you're a HICL shareholder where the risk looked relatively low, you are going to be taking on a bit more risk than you were. And then there's also a reference to having more debt capacity, which kind of implies that they're thinking about using that. And again, some people will be a bit antsy about this, as understandable. So they've got about 500 million quid's worth of drawings on their revolving credit facility, which is floating rate. And they're going to try and replace that by doing private placements of debt. So that will hopefully bring the cost of debt down, but at least it fixes it for the future. But what they sort of indicated here is that they could double the amount of debt that's in the combined portfolio, which again, I think most people would be a bit worried about. It becomes a sort of pan infrastructure renewables fund, really quite complex in terms of what it's got. This is just smashing the two together. This is very roughly based on the fact sheets. I probably haven't got the maths exactly right, but this is the sort of thing we're looking at. So lots and lots of different segments of infrastructure and lots and lots of different countries, all kind of OECD and developed, so no kind of emerging market risk there. Still a big bias towards wind. So you can see that's about 35% of the total. And if you're a HICL shareholder and you wouldn't be that keen on renewables, that's obviously going to be a bit of a worry. And then a whole raft of other things. So you'd expect that if they're shifting more to growthy things, then the old-fashioned, if you like, PFI type stuff will run down, I think. In terms of the new projects, there's a whole load of different things, and I didn't put that chart in here because it's just too complicated. But there's loads and loads of different bits of infrastructure. Now, on the cost side of things, these things don't come cheap. They've given each other an indemnity if they one of them backs out of the deal for whatever reason. What I've heard is there's 30 million quid's worth of fees going to the advisors on this, and we're not talking about the normal brokers. This is one of the things that I don't understand. We're not talking about normal brokers in the sector. This is Goldman Sachs and Rothschild people that sort of seem to sort of dive into the sector only when there's a big ticket on offer. And don't necessarily know what's going on otherwise. I don't necessarily know the investors. I just find it a bit strange that happens quite a lot, but there we go. So big, it's not a cheap thing to do, slightly offset by this NEV uplift that you get from buying back the stock at 10% discount. The TRIG buyback program is going to be suspended because all the maths has been done based on the situation as it was when they announced it, but the HICL buybacks will carry on going. But they're not coming up with anything to tackle those enormous discounts. So there was a Q&A session at the end of the analyst panel, which asked a lot of questions that I thought were quite relevant here. First one, and I think is a common one, is if HICL wanted to do a deal where it wanted to grow, and it's cast around for things to buy, there are lots of things that it can buy that are trading at a big discount to NAV. And if it was trying to maximize the uplift for its shareholders, if that was its only focus, you could probably pay a lot less than NAV for a book of assets. So why do this merger on a NAV for NAV basis? It doesn't really make sense from a HICL share point of view. Secondly, given that you've got a completely different risk profile in the new vehicle going forward than you have at the moment, you're much more likely to be unhappy with the new portfolio if you're a HICL shareholder than if you're a TRIG shareholder. So they rationalised the cash availability for TRIG on the grounds that there were a few people that hold TRIG that wouldn't like the new mandate. I think it's equally true, perhaps even more true of HICL. So it just seems wrong that there's no HICL cash exit. And the chairman also said, the chairman's answer to this would change of risk thing was just basically you can't please every shareholder, which I think is a bit weak. Now, the thing that we were banging on about last week was the change to the indexation of subsidies, which does take a chunk of money off the TRIG NAV. And they say that was reflected in the terms of the deal, even though it wasn't reflected in the 30 September NAV, which is what they've used. So I'm not quite sure how that works. But that's what the board said. I think there ought to be another adjustment, but there we go. And when people ask, well, you're doing a big deal, normally you look for cost synergies. Are there cost synergies? No. The answer is straightforward. No, there aren't any cost synergies here. You get slightly reduced overall fees because of the tiered nature of the things, but nevertheless, there are no big cost synergies. There's nothing going to be taken out here. Whereas there would have been if HICL had bought an infrastructure fund or if TRIG had bought a renewables fund, which it would make more sense. You could have taken out, a whole load of stuff. The TRIG board said it was attracted to the deal because the earnings for the combined vehicle will be more resilient than the existing TRIG earnings. But there's an implication there for HICL that it's going to be less resilient with TRIG involved. So that doesn't really stack up either. And there's genuine questions. I think it's just too appalling to contemplate, but we could get a government that comes in and scraps subsidies altogether. If that happens, then the value of TRIG that HICL's acquiring would be an awful lot lower, and HICL shareholders would have lost out big time beyond what they're going to sort of lose out on already. And there's no mechanism to compensate them for that. And there's a general question, well, I guess I've alluded to already, why can't they just do these deals, separate deals, and grow themselves? Why can't they go after growth opportunities if that's what boards want to do? They're already big companies. They don't need to be bigger. You can't really have a liquidity argument for doing it because these are already, 1.72 billion market cap companies. It doesn't really make sense. So a lot of people are unhappy. I think it's understandable. The people that sort of really jumped up and started shouting about it first were CG Asset Management because they are shareholders in HICL and not in TRIG, although they did hold TRIG and they sold it in the summer before this happened. And it's been pointed out that one of the things that's achieved here is that TRIG was supposed to have a continuation vote next year and now won't have one. So it's got away with that. So it just all smells a bit. I'm really not happy with the thing. I think there are very good reasons why HICL investors should vote against this. If you're a TRIG investor, it's probably the best deal that you could possibly get, and that's the whole point. But the reason why it's so good for TRIG investors is because it's bad for HICL investors, and you're really, one is being compromised with the other, and it shouldn't be that way around, given that HICL's buying TRIG. So there we go. Foresight Solar. So another disaster there, and you can see the share price going down more recently, along with the NAV. Really not great. Not very big company now, only 362 market cap on a 35 discount, but a really big yield. Now, what we want to talk about here is the latest quarterly NAV announcements, and it's not pretty at all, as you can see there. So the dividends sort of match the time value. That's kind of what you expect. Actually, power price forecasts that have been chip away at, they didn't come down again, which is good. So that's kind of helpful. There were some particular problems with some of the projects I'll talk about in a second. There's a big cut to the forecast value of renewable energy certificates. The sort of things that basically, if you're a fossil fuel power producer, you have to buy these things. And apparently, there's something I really dig around that. There is a sense that so much more renewable capacity is coming on, especially with the latest couple of auction rounds that the government's done to buy this stuff gets built, obviously. That there's going to be an awful lot more of these REGO certificates around, and that means that the price for them will go down, and that all makes sense. So that's going to be a thing that's probably going to be common to most people. Inflation is actually running a bit ahead of where they were thinking it was going to be, so that's been a positive thing. But there's some discount rate adjustments. So basically what those is them cutting valuations of some things in the portfolio, and we'll come on to why in a minute. And then the other big one in here is this tax review adjustment, so 3.6p off the NAV. So what was going on underneath all of that? So solar portfolio, they had very good radiation, so that should have been that they had a bumpy year in terms of generation, but there were a lot of outages where they lost their connection to the grid. That's not their fault. It's not something within the control. It's a national grid problem, or the equivalent in other countries. But that's not great, and that's just sort of something that I think needs to be improved generally. They've been trying to sell a portfolio of Australian assets, and there just haven't been any buyers for the price they wanted to sell on that. So that's a bit worrying. So they have written down the value of those to reflect the fact that they're not sold for the price that they're looking for them for. And they're still wondering, they still want to cash those in. So they're looking at what ways that they could do that maybe. And then also there've been trades for Spanish solar too, and they've been coming in at prices lower than had been hoped as well. This tax thing, I don't really understand, and I talked to a few people, and nobody seems to understand where it's come from. It's sort of something around just the assumptions that they were making were a bit optimistic, and they had chats with HMRC, and HMRC didn't like it. But whether it's just unique to them or not, we just don't know. But given that nobody else seems to know what's going on here, I would think it probably is unique to them, because otherwise HMRC would have been talking to some of the other companies. We will see. They said they quantified what the hit would be to this indexation consultation, and it's really quite chunky. So in the worst case scenario where the government just pretended that it had been using CPI all the way through rather than RPI, it would be a 10% hit to the NAV. And you've watched back the shows before, like basically on this day, it's a just terrible idea, and it would just basically raise the cost of private finance for everything that the government wants to do in the future, and end up costing them more money than they save. I think it's just a really daft idea. So with all of this going on, the chairman really sounded a note of disappointment. They are looking for a deal. I think that is like to come probably next year. We will see what happens, but what the price is for that, we will see. It did occur to me, because there's a lot of stuff getting written down here, whether they were sort of basically window dressing it a bit to say, well, look, this is the real value that we think it is, and come and pitch us, for a price around that. But we'll see. In the meantime, they're going to carry on buying back stock. And then let's have a good news story for a change. Murray Income, which we know that it's been suffering for a long time, and it's because it had a quality focus. They've been quite good about buying stock and keeping the discount down. And then when they announced that they're going to do something, the discount narrowed a bit. And they've said that they're going to put Artemis in as the manager. So it's a straightforward swap of Aberdeen to Artemis. The Artemis team, I quite like. It's kind of weird that, given how good they are, that they haven't had a investment trust to run before, but this will obviously solve that issue. And they've just had this pretty consistent good returns for a long time. There's basically no real change to the strategy of the fund, because it's the same objective, same benchmarks, same gearing policy. They're going to carry on growing the dividend. They're going to carry on buying back stock. There's nothing really different there. And so because of that, there's no need to offer a vote for shareholders, and the board felt there was no need to offer a cash exit because they're going to be buying back stock anyway. And I think I agree with that. It's not something so radical and scary that people want to sell. Although if you did want to persist with like a quality approach, what I've said when we commented on the deal was that best thing is just to switch into either to income and growth, which is same manager quality style, or something like Finsbury Growth and Income. And you tell from the performance of both of those that these are qualities been suffering for a long time, and the part of the argument might be that it turns, but we'll see. Obviously, it comes with a lower fee, which is good news, and based on the low market cap and NAV, which is obviously good news. And the Artemis is going to waive the fees for 9 months because that covers the cost of doing this deal, which are not that big anyway. And the notice period is only 3 months. With the contrast between that and the notice period that HICL and TRIG are prepared to hand out is just bonkers. But there we go. So tick, I think. The reason it works, or it seems to have worked so far, but it's got a long track record of working, is they're not pigeonholing themselves as value or growth or quality or momentum or anything like that. So they're trying to be pragmatic about stuff. They're not just buying what's in the benchmark. They're not just buying the big income generators. Everything they're kind of looking at, they're forecasting out 5 years. They're looking at the cash flow generation. They're saying, can that cash flow sustain dividend growth? And if it can, it'll make it into the portfolio. And that all makes complete sense to me. So that's the track record. They're going to do a shareholder presentation. I've seen an analyst one that is not up on the website, so there's like a screen I was going to have to catch, but they did show a chart. So look out for it when you do the shareholder presentation. Basically, just show that how many rolling periods they've outperformed in, and it's very, very rare that they've underperformed. Because it's not skewed to a particular style, there may be times when it's not top of the pile, but to be top quartile over most periods is actually quite good news. So I like this. I think it's a good result from our income. It's just in a graph form there. So good luck to them, really. So that's enough for me. There's loads and loads of comments come in here. Is HICL a buy if the discount's so wide? I think HICL's definitely a buy if they turn around and say we're not going to do the deal. Even despite this kind of break clause thing, it's not that big in a great scheme of things. So that would be taken as a positive. And obviously, one of the things that I'm thinking of is that by doing this, if shareholders reject it, they basically put both of themselves in play. So it would just be interesting what happens. Some conflicts of interest we can't see. We don't know. I'm not going to go into that. It's just like trying to, probably not a good idea. That's probably it. So we'll stop there. We'll hand over to Alex, and you can tell us a much better story about Bankers Investment Trust. So cool. Let me give you control of the slides, and I'll let you drive the presentation. You can tell us about the trust, and then we'll go to some questions.
Okay, thank you. Thank you, James. So let's couple of slides just on the trust and how we operate to set a scene, and for some of those listeners who maybe don't know so much about us, and then I'll touch on my outlook and how I'm seeing markets. I'm sure there'll be some questions on that, and then finish up with our positioning and how we're sort of currently structured. So let's talk about Bankers. I mean, core principles. We have two objectives. Most trusts have a single one about a benchmark, and we're trying to obviously outperform a benchmark of global equities, but we're also trying to grow the dividend above inflation. And so that's important, I think, for a lot of our investors who rely on the income and the growth in the income. We've 58 years, fractionally behind City of London by about 4 months in terms of that long-term record, and ahead of the rest of the bunch. So 58 years of annual increases in the dividend. So a very powerful statement of why investment trusts are really good for income and income generation. We're focused on a sort of portfolio of about 100 stocks, but really set into 4 regions, so we're trying to cover the whole world. We can invest anywhere we want. We've got licenses in pretty much every market, and we've split the world geographically. But we talk as a team about the stocks we own, and we can sort of overweight one in one region because it gives better value or better opportunities. But about 100 names. We cut this right down, so some of us may have seen me a year or two ago. We used to hold more. We had a big, deep review last year and decided to simplify, really, I think is the best way of thinking about it, to follow really where we had the greatest conviction to try and put more of the capital into those investments, and so cut the tail quite dramatically in the portfolio. And I think, apart from sort of a tricky time around the election back in November 24, when Trump got in, and global equities, there were some rather extreme price moves in some stocks which have sort of settled down this year. We're roughly ahead of the benchmark just about year to date, and so I think it is beginning to work quite nicely, that increased focus. I work for a company called Janus Henderson, who have the management contract for this trust and have held it since the 1970s. So a long-term relationship there, and very much what we believe in. We're a big firm listed in New York. A lot of analysts, sort of 200 plus investment people on the equities side alone, and we have local experts. Really, our analysts are based predominantly in the regions. So although the PMs, some of them, Junichi, my Japanese manager, is in Tokyo. We really are drawing on local expertise in these markets, so the ability to get to meet companies and know their markets well, and that therefore gives us the flexibility to shift around a little bit between value and growth. I think we've moved a little bit more value in international markets, continuing really generally with a growth tilt in the US, and that's been delivering reasonable returns. And then finally, low costs. The management fee, the all-in cost is sort of 0.51 there, with all charges in there, and the management fee is a tiered one. So as we grow, the fee should fall, hopefully, and low cost debt. So we refinance all our debt through the last sort of 7 or 8 years. So our debt extends out to 2045, so another 20 years before the last one retires, but an overall cost of 2.7%. So we're not relying on very expensive short-term borrowing facilities. The team itself, here it is. Myself, I've been managing this for since 2003. So very much been enjoying managing this trust over those years. And then I've been joined recently by Richard Clode, who's a colleague I've worked with really quite closely for about 7 or 8 years. He's been with us for nearly 10 at Janus Henderson. And so I know him very well. He has a technology background, which I think is going to be really important for the next 5 or 10 years of investing, in my mind. I think particularly, I'll talk about it later and we can talk about it in questions, but it's about the adoption of AI and how really the new technologies are going to filter through all companies. That I think really is exciting about what Richard brings. So not just his expertise in the current big IT companies, but really how they're going to adopt technology throughout different industries. So Graham, I'm really pleased he's come and joined me. A lot of expertise, a lot of experience, as you can see there. A very fine fund manager. So the rest of us, average of sort of 25 years of experience there. So again, a very experienced investment team, but sitting on top of some sort of 70, 80 analysts that we have around the world, who really are spending their entire days looking at stocks and trying to think about them deeply. So as a team, we work very closely. We try not to overlap in too many stocks, but really try and make sure we're consistent, talking about the themes we see in markets and investment ideas and how they affect the different companies and the different regions we manage. So let's move on to sort of talking a little bit more about how we see the world. And I think there's been a lot of challenges in markets, and I think reflecting a little bit on what's been going on. I think two things really have worried investors, but actually markets have climbed that worry, and I've actually, from a market point of view, sort of put it aside. The first one is obviously tariffs here. So on the right is the US effective tariff rates, and we can see that spike. We remember Liberation Day with Trump with his board of 30, 40%. on a lot of import goods. We're not anywhere near that. Deals have been done sort of in the 10 to 15 to 20% range, and there's a lot of offsets, and we're hearing more, and we probably don't know, all of them, and there will be more to come, I think, of goods where they just recognize cocoa, coffee, all sorts of food stocks that aren't grown in America, but they enjoy consuming. So I think there'll be lots of offsets and concessions. So maybe this ends up at 15%, but it is manageable. The companies we're talking to are saying, look, we take a bit of a pain, and the importer takes a bit of pain, but generally this is manageable and isn't affecting sales materially. On the left of the inflation worries, so these are the inflation rates. So I think look maybe at the green line, which is the sort of core goods, which you expect some of that, less foods and energy. It has risen a little bit, but it's manageable. It's sort of still under 2%, and the core levels, again, flicked up a little bit in the last few months, but they look, again, very manageable. Rents are falling. So I think I've got a slide in a minute, we'll look at, how interest rate cuts may be coming. But I think, it isn't the big spike. It isn't the 4 or 5% with rates having to go up that everybody worried about. So I think we're transitioning through the worries about tariffs. And then the other worry is really about investment, sort of a bubble, AI spending, and really whether it's a deeper question about the returns, but really whether this spending is too much. So this is an interesting graph looking at the line there rising. The single line is the cash flow, operating cash flow of these hyperscalers. So the big US companies that are basically investing the majority of the money into the AI and data center expansion. Their cash flow has been inflecting upwards as they're very successful businesses. Companies like Amazon sort of winding up the margins and the prices they're charging, and therefore the capex is going up, to Microsoft, growing very strongly in cloud services. So basically, they've been growing cash flow, and therefore the capex, that sort of green box there, it's been expanding very rapidly and continues to accelerate, but it's within the envelope, in my mind, of their cash flow. They're not cash flow negative yet. They're still buying back stock, as you can see the browner line there, and they're still paying dividends. So I think still manageable. It is accelerating. So I think we're in a boom, not a bubble. And bubbles are characterized by excessive leverage, excessive IPOs at ridiculous prices, and these sort of elements. Now, until the AI boom becomes sort of heavily leveraged and debt funded, which I just, it will do one day, but it isn't at the moment. So I think at the moment, very manageable. It's managing it within their cash flow, and these businesses are very profitable and lower ratings actually than the peak. They're half the ratings that we had in the dot-com boom. If you look at price to EBITDA multiples or traditional PE multiples. So I think still a manageable phase of expansion and interesting opportunities. If we look for next year, so look at it a bit more outlook, I'm reasonably positive about next year. I think this year has been challenging from a macro point of view. Companies we meet have said, look, we have slowed investment, we have slowed hirings because we just wanted to see how some of these issues transpire and move forward. And I think it'll settle down into 26 with the benefits of some quite big things. In America, we've got tax giveaways from Trump's big, beautiful budget, both to consumers and corporates will be saving tax. And then the tariff situation will move through as it does, sort of one-off adjustment in price. So you see here on the left chart, the GDP growth expectations on the left of the line, which is historic to some extent, lots of volatility there. So quarter and quarter, choppy and very difficult for companies to be managing those variations in demand. As we look forward, these are the UBS forecasts, you begin to see it settling down a little bit, particularly with the US sort of matching European growth, but sort of 0.5% per annum for a quarter, so 2% per annum. It's quite a nice stable background with what hopes some interest rate cuts as well. On the right is looking again just at US earnings against European earnings, and it's been the key reason why US market has continued to outperform. Again, it's been a bit choppy in the last few years through COVID, but I think you can see on the far right, that green line, the trailing earnings relative between the US and Europe is beginning to stretch upwards again. So, one hopes German expansion, fiscal expansion comes through, but I still think the US is the place to be hunting for a lot of your stocks. I mentioned finally that I think we will see some rate cuts next year. So again, the left-hand chart is showing you how much the market is pricing in interest rate cuts. So roughly another 2 quarter point cuts for the UK and 3 quarter point cuts for the US. I think, a bit tricky in December whether the Bank of England cuts. It might do. I think the Fed will probably skip December and cut in January. But I think the pressure then rises on both central banks really to be cutting next year into some slightly better inflation numbers in my mind. So I wouldn't be surprised if we get all the way down to a 3 in front of the interest rate, both here in the UK and in America. So I think that's again be bullish for equities and then the market. Finally, and sort of through aspects, the challenges often are, look, isn't it very expensive equity market? It is more expensive than historical, and you can see that the PE ratio there has been rising in the last few years as this AI investment spending is supporting the economy and growing earnings. But I would look at the blue line, which is the margins, operating margins for US companies in the S&P 500. It is still rising. So margins are going up, companies are more profitable, and you therefore pay a higher price for that, in my mind. It justifies the higher price because they are better quality businesses and earning better returns on their invested capital. And I think this continues to go up. I think you'll find, again, say some of the discounts in the offsetting taxes, investment spending, some of the tariff impacts will bring for US companies more manufacturing onshore, and more volumes against some of their competitors. So again, more reasons I think next year to continue on the whole to sort of focus on some of these US names. Not to the extent of all markets. I think there's still Japan is another area I favor and have favored for a while. It's done quite well. It's held up reasonably well through this year. Again, sorry for all the lots of lines. The one I wanted to focus on was on the left, which is Japanese compensation. So wage growth is the green line, has been rising and is roughly 4%. Doesn't sound a huge lot, but when it's been a 20-year stagnation in the economy, to get 4% increase in wages is important and is helping offset some of the inflation in that market. But it is driving consumption. So you're also seeing the red line there going up, which is consumption in Japan. Again, that's all helping the stock market in my mind. So again, I think some quite interesting trends going on there. So how are we positioned? I think one of our key themes has been predominantly financials and particularly banks. I think there's lots of reasons in here. So first of all, that they were very cheap. So on the left is the just look at European banks PE relative, so the price relative to the market. If we go all the way back to the start of the GFC, the financial crisis, they were sort of roughly trading in line with the market. It's lost all of that premium, almost trading at half the market valuation as it was building capital, reforming. And really, I think from that level, to my mind, we're at a position where capital is adequate now. It doesn't need to be rebuilt. If anything, we may see some deregulation, reduced capital requirements, which again would be supporting growth. So I think growth has picked up. Interest rates have risen, which means returns on deposits are rising. The spread is rising for banks. So lots of positives in here. But on top of that, again, we're seeing investment borrowings begin to improve a little bit. So loan growth is improving. And I think finally, I think this is a sector, financials in aggregate is likely to be probably the early beneficiaries of AI adoption in terms of productivity and improvements in cost and margins. So I think this is probably, if you said which sectors taking on AI quickest and adopting, it is financials, starting with the big banks who obviously have more capital and more investment to spend on AI. So as we look that trickle down, that diffusion, I suppose, of the AI investment, you're building data centers to cope with handling data and improving how you use your data. I think the financials are going to be one of the sectors that will see the benefits quicker. So another reason to own it. So when you look at our exposures there, that financials is our largest overweight position. also provides very nice yield, which is always helps. We are sort of broadly in line with IT, so we're not hugely overweight. But within there, the key holdings are probably Amazon and Microsoft are our largest overweight positions in the sort of Mag 7 names. But we have a decent exposure to semiconductors and some of those hyperscalers that are building out the networks of data centers. So again, that we like that. We're quite underweight, I suppose, historically, the consumer. I still think in Western markets there are pressures on consumers from price rises coming through. So again, an area we're sort of much more lower exposed than we have been historically. These figures are sort of September, as always. They have to get these presentations lined up. The October numbers are on the website, and they will show a little bit more investment into North America. The downturn we've seen in the past few weeks, we see as transitory. Markets don't go up forever; they do have pauses and pullbacks. But looking at the underlying earnings and talking to companies through the third quarter results that we're just sort of finishing up with, I think it's a very positive message coming through about investment spending and the picture for next year. So with that, I might pause actually and let James maybe take some questions.
There we are. I am back. Very good. Thank you very much, Alex. It's very interesting. It is really interesting because it's sort of running slightly counter to a lot of the headlines. I mean, I was looking at that because a few people have been saying, "Oh, maybe you should start looking at consumer staples," and you're actually quite underweight that. So you're basically saying this pullback is temporary and it's not time to start running for the hills.
No, I just don't see. The big bit's about right. We're in a bubble, and it's going to crash imminently. And I think some of the signs, the negatives, they say, well, look, there's a lot of cross holdings. Everybody's investing in everybody else. That's a terrible sign, isn't it? I think when you think about it, if you were Nvidia with sales of 50 billion odd a quarter, and the amount of cash they've got, wouldn't you, help the supplier base, to continue to grow this? Because if everybody if AI is the next sort of industrial revolution, then you want as much of this stuff to feed through, and they're not throwing it away because they'll sell these chips to somebody else. They're in huge shortfall. So they'll take the chips back if there is some corporate failure. But I still don't see it as a position. That chart, I think, is very powerful. The one that when you look at Microsoft and Amazon and Meta and all the big boys that are spending, they're doing it within their cash flow. They are not. There's another graph I've got, if I just jump through, which is quite an interesting one, which is this one, which is basically capex of the technology sector against sales and then free cash flow. Now, I think sales is a slight misnomer. It depends on your margin. You can sell things at 90 cents to everybody, but in the pound, 90 cents in the dollar. But the blue line is the key one. The capex to your free cash flow is running at about 40%. It's on the right hand side. It was 78 odd% at the boom of the .com era. So we're not there yet. And I think, I do think the market is still going to see some very strong numbers come out of a lot of these names in the next year. And the consumer side, we are buying some actually. I mean, I've started a holding in Diageo. I am, I think there's a few companies that are really hitting very low multiples, but I think it's early days to start nibbling rather than, getting yourself materially overweight in some of those consumer stocks.
It's fascinating. I mean, I suppose part of the reason why people have been nervous about AI is this end use case thing. Are you using it at all yet in managing the money? Are you helping you doing research or anything? Is there anything going on within Henderson?
Again, I think yes, there is. So I think it's about the productivity. How can we improve things? So a lot of the jobs that I do that take me away from looking at stocks, writing reports, writing updates for people, a lot of that is beginning to do. And so we have systems that do all the attribution analysis. It just chunks it through. It knows what I own. It knows what I bought and sold, and it goes, right, here's your performance data. And I've just got that now at my fingertips. It chunks through corporate earnings figures. We again, through Bloomberg and other systems, we can quiz it with questions and say, tell me the inventory story here, and it just chunks it out. So I don't have to spend hours getting to page 52 of reports. So I think productivity gains, I'm spending more time, materially more time looking at stocks than I was doing non-investment activities. And then for the business, again, we're hearing lots of great examples of how it is reducing time and allowing people to do actually productive tasks, whether it's filling out requests for information for clients or presentation writing and things like this. So there's no killer app yet, but I just think we're in the early days of how, freeing up people to actually focus on productive aspects of their jobs to grow their businesses is going to be the next phase.
Within the financials, you talked about banks, and are you worried that there's any kind of pressure on interest rate margins as interest rates come down, or are we not there yet?
So I think what you need to know is a lot of banks hedge this exposure, so they will, and they hedge it much longer than you think, so 3 or 4 years. And so so that leaks into your net interest margin or leaks out. And so in that respect, if you talk to particularly UK banks, they would say we've got still 2 years of reasonably good peak net interest margins before the rate cuts that we've just started to see begin to ease into those numbers. So I think you've got years before you'll really worry about if rates do go down as far as sort of a 2 in front of them, but they're not. I think they're going to slip down to maybe low 4s or a 3, because I think inflation is bubbling away everywhere. It's the genie that's out of the bottle, as it were. It's going to be very hard to get that under control. So I think it's in my forecast, it's in our numbers, our modeling. It's a slight degradation in the net interest margin. But on top of that, is really, if you can get some deregulation, some sensible deregulation, I'm not talking about going back to the wild days of massively leveraging balance sheets, but there's a lot of some aspects I think of that could be solved in there, and focusing on lending again. Lending growth is very low at the moment. Now, it should be in the sort of, I think it should be double GDP. So we're talking sort of nominal GDP. It should be about 6 or 7% in the current market, and it's basically 2. So if that picks up on top of all the other things, you should see dividends as well continue to grow. So the dividends and buybacks is roughly sort of 10% of market cap at the moment, annualized. It's pretty impressive. So you're chunking away with that with underlying earnings growth. It's not difficult to get a 15% sort of total return story, if not 20% in these names.
And then outside of and then outside of the banks, are you buying asset managers, insurance companies, that sort of anything else like that within financials?
Yeah, we still really like the card processing names. So Amex is probably our biggest holding in that space. So we like that from a sort of also a travel point of view, but they seem to be winning a very nice game of accumulating new clients. It's an aspirational brand for a lot of people, and therefore they're growing their client base much quicker than their competitors. So we quite like the card processors. Again, the world is going ever more non-cash. So again, it suits them and the systems where they transact over. So probably that's the next biggest bit. And then after that, insurers, it's more tricky. We do own them, and we're starting to take some profits. I think they push price. They've had a challenging time because a lot of the costs of whether it's repairing cars or all sorts of things have been quite challenging, and they push price up. But I think you're beginning to sort of, I think, sense where those margins are likely. The difference between obviously what they're charging, what they have to do to repair things is beginning to crunch a little bit. So I think a little bit more worried about that area. So profit taking rather than net investing.
And sticking with sectors, what's the view on healthcare at the moment?
Here we go. It's very mixed. Obviously we've seen quite a lot of volatility. The big names in there, the GLP-1 names. So Novo and Lilly have been the star performers. Novo stumbled this year for many reasons, and then Lilly had a big fall, but has just rallied again in the last month. So increasing volatility in that space is obviously, I think, primarily the Americans, quite understandably, say, why are we paying so much more for these drugs than they're being charged to other nations? So we're in a sort of funny phase where there's been a lot of price realization. I think I think we're getting to the end of that. So I think, that's definitely, hopefully we as investors and the companies understand really what they're going to be charging for things in the next couple of years in many of their markets. And the tariffs, again, haven't turned out to be quite as painful. They can move production and they will invest more in the US. So I think it's settling down, but it's still quite volatile if you've got a good drug or a bad drug, or things don't work out for you in your new developments. So we prefer, medical supplies companies. So again, the consistency of those operations and their rising wealth is meaning more people are having these operations globally. So growth in emerging markets is quite strong. But so these are knee operations, all sorts of eye surgery and things like that. So I think that's probably where you want to focus, and where we are a bit more focused. Some good names in the US again in that market. So healthcare is underweight, but underweight pharma against, and we've taken some profits in the Lilly rally that we've seen. That was our biggest holding. So it's still a bit mixed. It's not that great defensive sector. It's re-rated downwards. But again, if I'm right in saying, look, I think we're still in a relatively good growth phase of the market, it's going to lag.
Emerging markets. Do you have got much exposure to China within that Asia segment there?
Much lower than we've ever had for a long time, I think, really, for 15 years or something. The names that have done well are either some of the more speculative sort of technology names, or quite high yielding sort of big staples and defensive companies. And the reason they've done well is that the interest rates have just been slashed in China, and investors have been pushing lots of money into high yielding equities. And so they've been doing well, but not for any great reason, for profitability gains. So, and it's still an economy, we're sort of struggling to see great growth drivers. Again, the government support a lot of industries and they're exporting well, but again, those channels are getting ever tougher as I think, countries are rightly saying, we'll stop dumping goods in our markets. So I think it's pretty low. So China's about 1.5% or something, 2% of that Pan Asia, not 2%, a quarter, I suppose. So 2% of the whole portfolio, but we have been over 10 at previous times.
Okay, cool. Can you explain sort of the big picture thing about how you do manage gearing and cash, and where we are with that at the moment, please?
Yeah, so if you're obviously know Invest Trust well, we can borrow money from investors for long term. So loan stocks, these are called, or debentures, are the old sort of thing. So we've got three loan stocks running out to 2035 is the first one that's going to retire, and then out to 2045. We've got some euro debt and mainly sterling, and so the cost of those in aggregate is about 2.7%, but it's fixed, so it's quite nice. That's much lower than interest rates, and it's obviously saved us relative to borrowing from the bank, with a chunky margin over 4% base rates. So that's sort of fixed. Now, obviously, that's fine, unless your assets are collapsing and suddenly the leverage is very high. So that in total is about 9% of our assets. So our leverage, if we were fully invested, would be about 9% gearing. And so very manageable and about the right rate. I think if rates came down and I got another opportunity, it'd be nice to go to about 12% of long-term borrowing. But I think 9's fine. The markets have gone up and therefore the gearing's gone down. But we hold a little bit of cash against that, really for sort of essentially for working capital. And we are also buying back, we feel the discount's too low. So we're buying back some shares. So I need a little bit of money to manage the discount buyback, and taking opportunities where we see suddenly a market dislocation. We don't want to sell something, we'd like to buy it out of cash. So at the moment the gearing's about 6.5%, so it's about another 2 and a bit sitting, and that's earning the base rate. So actually the cash is earning more than the cost of the leverage, which is a unique opportunity. So that's earning about 4% and 4.2 in a cash fund. Great, thank you. And there was a question about the discount. So basically, it's buybacks is the best tool for managing that. We think so. Yeah, I think there's lots of. We were on a premium in 20 as not far back ago, sort of 22, and we were on a reasonable premium before that. and it went out, slid out with all the other trusts in sort of 2020, late 22 into 23. And I personally think it's a function of initially their interest rates rising. The noise. Interest rates going up quite sharply, and investors pulling money to invest either in long gilts or cash deposits, and that's affected us, I think, as investment trust community. And then, recent year, let's be honest, government uncertainty on tax rates and whether you should be passing cash to your children or taking capital gains. And one hopes next week's budget gives us some certainty. I doubt it will. Or overhanging questions, but I think that's led again to people slightly artificially selling things to realize some capital gains. So I think the pressure there, we've narrowed that discount. It's sort of high single figures now, but it's I think it should be in single figures at worst. So we will buy back reasonably aggressively if it's beyond that. So I think it is the right tool for us at the moment.
Obviously, the UK market does look quite cheap relative to a lot of other developed markets. Is that reflected in the weighting? And what do you think the budget might do to that?
Yeah, you need to sadly remember that when I started, I think the UK was sort of nearly 15-20% of global markets, and it's about 4 or 5 at the moment. So it's really lost its way in that sense of its scale. But there are some great companies, and so we are about 6.5-7% of that, pan-European. About a third is UK, and yeah, there's some very good companies we see at good valuations. So we hold things like National Grid. We own NatWest Bank. Is the biggest, second largest bank holding is NatWest, which we still see some opportunities in. And then there's slightly smaller things like Cranswick, which we've owned for a long time. Pork, probably again very good, stable. It's never really issued any stock and always just manages itself within its cash flow. And invests very heavily. So some smaller ones and some bigger ones, but within a portfolio of 100, you're limited to sort of 6 or 7 names in the UK. But there are some opportunities, and we're overweight. Yeah.
Great. Okay. Thank you. I think we covered a lot of ground, and we are nudging up towards 12 o'clock. I was going to put that's the top 10 active positions, which is obviously kind of interesting.
So this is against the global benchmark, isn't it? Yeah. Remember that. KLA makes, so it's part of the semi space and semiconductors, and they make really the global leader in terms of testing of wafers. So as the wafer size gets ever smaller and smaller, we're talking 3 nanometers and maybe going to 2 and maybe even 1 cutting edge. You really need, the failure rate goes up. You really need the leading edge testing materials to say, well, are we making these things and are they working? Because if they start failing on you, supply issues. So KLA are really the leading provider of that information, that stuff. And then Broadcom is sort of is called ASICs, application specific chips, which again is competing against NVIDIA. So.
Yeah, exactly. Brilliant. Okay, thank you very much indeed. We should probably wrap up there because given where we are. But thank you for the time.
Thank you. Well, thanks
this morning, everybody. And good luck with it all. Yeah, good. All right. We will be back next week. We've got something a bit different next week. So I'll be doing the news as usual, and then David Batchelor, who most of you won't know yet, but he's our probably newest recruit. He's going to be leading a panel of talking about active ETFs, and we're just looking at how they sort of might fit into a portfolio. So that should be interesting. So have a good weekend, and we will see you next Friday. Thank you.